With equity market valuations looking so high, many people are looking around for a potential trigger for an equity market sell-off. And I think one candidate comes from a fairly surprising source, and that's stablecoin, which are supposedly the most stable types of cryptocurrency. So how could such an innocuous asset trigger a market sell-off in equity? Let's look at that in a bit more detail. Today's video is sponsored by Noah, an audio app which I use to listen to articles which I don't have time to read. Check out the link in the description to get a 7-day free trial and 37% off premium membership. So what is stablecoin? As its name suggests, a stablecoin is a cryptocurrency which is tied to the value of a currency. So for example, here you can see the value of a cryptocurrency called Tether, which is tied to the value of the US dollar. And this graph tracks its price since 2016, and you can see it's done its job. It's kept its value at pretty much $1 throughout that entire period. Now there were some wobbles, so for example you can see it dropped quite a bit in 2017. In fact, it almost touched 90 cents, but on the whole it's done a pretty good job of sticking to that $1 value. You may be wondering, why bother with something which looks like a dollar? Why not just use dollars instead? Well, the reason is that it's easier on some cryptocurrency exchanges to trade a cryptocurrency for another cryptocurrency. Or it might be the case that, for example, Chinese investors find it easier to get around regulations by trading one cryptocurrency for another, rather than trading renminbi for Bitcoin, say. Tether is currently the most popular stablecoin, and this looks at its value over time. This is also called its market capitalization, but you can think of it as the amount of dollars which is stored in the form of Tether. Now its popularity really took off in 2020, and you can see that its current market capitalization is not much short of $70 billion. Now Tether's by no means the only stablecoin out there, so for example the second most popular one for US dollars is the US dollar coin, USDC, and its market cap is just over $28 billion. Now it hasn't escaped the notice of regulators that stablecoin is very much like a money market fund, because money market funds, just like a stablecoin, try to keep the value of the fund almost exactly at $1. For example, one of the largest money market funds in the world is the Federal Money Market Fund from Vanguard. Its current value is $1, and it's very stable at that price of $1. But in contrast to stablecoins like Tether, these money market funds are strictly regulated by the US government, and that's to ensure that they only buy safe assets, such that their value will always be $1. If we look at the objectives of that money market fund from Vanguard, you can see that it has to maintain liquidity. That means that it's always possible to sell some of the fund in return for cash without crystallizing a loss. So if you want to store money temporarily, these money market funds make a lot of sense. But of course, you'd never invest in a money market fund for a long period of time, just as you'd never put your money in cash for a long period of time. So if you put $1 into these funds, you know that at any point in the future, you could take $1 out. How does it achieve that stability? Well, it has to invest in super safe assets. So that would be government bonds issued by the US government or some of the US government agencies, or they could be repurchase agreements which are based on US treasuries as collateral, but they also have to have very short maturities of 60 days or less. Because remember, if the duration of a bond increases, that increases its volatility, because it makes the bond more sensitive to interest rate fluctuations. So the credit quality of its investments are very, very good, and it keeps its duration very, very short. And that way, it ensures that it's almost always worth $1. Now, because the goal of stablecoins is pretty much the same as the goal of money market funds, which is always to be worth $1, they buy pretty much the same assets, which tend to be very safe things. So perhaps one way to visualize this is that money market funds and stablecoins are like two pigs that eat from the same trough. They both buy commercial paper, so that's loans to companies which are very short in duration, but also which have a high credit quality. It's very unlikely that the companies will default in the next 60, 90, or 180 days. They also buy very short-dated government debt with very short maturities, which are very insensitive to interest rates. Those are called T-bills, treasury bills. Or they could make very short-term loans to banks. These are called certificates of deposit. Again, these come with very low credit risk and zero sensitivity to interest rates. And if you borrow short-dated treasuries from the Federal Reserve, say, that's also an instrument which gets you a small interest rate and which carries a very small credit risk. Now remember the pig and trough metaphor, because that's going to have a bearing later on in the video on how stablecoin can trigger a financial crash. As part of my research for this video, I used this story from The Economist, but it was actually narrated on an audio app called News Over Audio, or NOAA. What's great about NOAA is that I can be out walking my dog Teddy and working at the same time. Now, NOAA is not a source of breaking news. Instead, it curates the very best stories from a variety of sources, such as the Financial Times, Bloomberg, and The Economist, and many more. And then NOAA's editors combine these stories into a series so that you can see the same story from multiple perspectives. Here's what the app looks like on my phone, and you can see that you've got quick access categories here. Or if we want to see what's trending at the moment, we can see the latest stories which are very popular. But I think the most powerful feature of NOAA are the series. And here you can browse them by category, or alternatively I could just search for stablecoin. And here's the series about stablecoins causing another financial crash. PensionCraft viewers get a special deal with NOAA where you get a 7-day free trial and 37% off premium membership. And to get access to that offer, just go to the link below me, which is also in the description of the video. Now, money market funds and stablecoins have to do just one job. They have to never break the buck. But in 2008, that's exactly what happened with the Reserve Primary Fund. Now, this was absolutely shocking because it was a very old fund, which was very well respected and trusted by many people not to break the buck. But the problem, the reason why it broke the buck, was the fact that it had lent money to Lehman Brothers, but it had done so in the commercial paper market. Remember, these are very short-term loans to a company which usually has a very high credit quality. Often it's an investment bank. And Reserve Primary held a huge amount of this paper. In fact, they'd bought $785 million of Lehman commercial paper. Now, after Lehman defaulted, the value of this commercial paper dropped almost to zero, and that made the fund break the buck. As a consequence of that, many people pulled out their money from the fund and it was forced to liquidate. In fact, there was a run on money market funds. So I think it's helpful to understand exactly what we mean by a run. And typically when we talk about a run, we're talking about a bank run. Now, this is the balance sheet of a bank. In fact, it's Bank of America at the end of 2020. And over on the left-hand side of the graph, you can see the assets of the bank. That's the stuff that the bank owns in order to generate an income and hopefully profits. The panel on the right are the liabilities of Bank of America, and that's how it paid for its assets. So for example, it took in over $1 trillion from its customers in the form of bank deposits. But you might be wondering what would happen if all of its customers asked for their money back. So that would be over $1 trillion. Well, you can see the problem right away. They only have about $390 billion in cash. That's because when they took the deposits from their customers, they actually lent out the money in the form of loans, because the loans will generate an income for the bank. Whereas if the money just sits around on the balance sheet in cash, then it's not going to generate any revenue. So this is what would trigger a bank run. If lots of people demand their money back, then the only way for the bank to give it to them would be to sell some of its assets, which might take a while. And if people are in a rush to get their money back, then effectively the bank could become bankrupt. Why doesn't this happen? Well, that was the whole point of the central banking system when it was first created. In fact, there used to be loads of bank runs in the 19th century. If you live in the UK, you may remember Northern Rock, which had a bank run. And again, this was during the global financial crisis when people were worried that the bank was going to fail. So for them, it was worthwhile queuing in order to remove all of their money and transfer it to another bank. But the psychological process which generates it, which is fear feeding on itself and people trying to pull out their money, is universal to bank runs. Another reason why it doesn't usually happen anymore is that the government ensures there's a guarantee for depositors up to a certain limit. So for example, in the US, most banks have the FDIC guarantee, which guarantees up to $250,000 per depositor per insured bank. In the UK, we've got something similar called the Financial Services Compensation Scheme, and here the limit is £85,000. Australia has the FCS, which is the Financial Claims Scheme, and Canadian deposits are guaranteed by the Canada Deposit Insurance Corporation. And here's the guarantee for stablecoin and money market funds. Oh, there isn't one. So that's why people get scared if they have parked a large amount of money in these supposedly safe entities. And stablecoin is no different. So neither money market funds nor stablecoin comes with a guarantee, but Tether is much riskier than money market funds. Now, Tether received quite a bit of criticism because it wasn't transparent about the assets which it was holding. So in June 2021, it published this audit showing exactly what it owns. The area of these blocks shows you the percentage of assets in that type of investment. And what was reassuring was that quite a bit of it was in the form of cash or cash equivalents. So 31 billion was in commercial paper and certificates of deposit, 15 billion was in T-bills, and about $1 billion was in reverse repo, and about 6 billion was in cash and bank deposits. So all of those could be sold very quickly and used to redeem investors. But what triggered some alarm bells was quite a bit of the investments were in very illiquid assets, but also very volatile assets. So that included corporate bonds, which are very volatile and subject to credit risk, but also precious metals like silver and gold. Also some secured loans, which of course are very illiquid. If there's a credit problem, these things can take a very long time to sell. And there are even some investments in other tokens. Now these are the kind of investments which a money market fund couldn't even dream of buying because they're simply too risky. And there's a real risk that these assets could lose value very quickly in a crisis. And if that happens, the value of the asset backing the stablecoin could fall very quickly. Now, commercial paper also gets credit ratings. They aren't the same as the credit ratings you'll see for corporate bonds, which is AAA, AA, and so on, but the highest credit quality is A1+. And you can see that quite a lot of Tether's investments were in that category. But there's also quite a lot in A1, A2, and A3. How does that compare with a large money market fund? Well, as an example, we can compare with the JP Morgan Prime Money Market Fund. And if we look at its description of its credit quality, you can see that it only invests in commercial paper, which has a credit rating of A1. And that's because in a credit sell-off, that kind of high quality paper will lose very little of its value. So the credit quality is lower than that of a money market fund. How about the duration risk? Remember that long duration means greater volatility and greater sensitivity to inflation and higher interest rates. So here's a breakdown of the maturity for that JP Morgan Prime Money Market Fund. The big spike, which is next to me, shows you that almost 40% of the fund is invested in paper which has 1 day to maturity. That's effectively zero duration. And that money will be almost insensitive to interest rate fluctuations. And only 8% of the fund has a duration more than 180 days. If we compare that with Tether, you can see that the story is very different. Now we have about 45% of the fund invested in paper which has a duration of greater than 180 days. So we've seen that it has more credit risk and it has more duration risk. Clearly this could be a problem down the line. Now until 2020, this wasn't really even on regulators' radars, and that's because stablecoin was fairly small. This is a presentation by Eric Rosengren, who is the president of the Boston Fed. And what he's showing is the size of these stablecoin funds relative to money market funds. And you can see that they grew explosively in 2021, such that they're now almost a quarter of the size of money market funds. And yet remember, these stablecoins are completely unregulated. And during an interview with Yahoo Finance, Rosengren said he's worried what happens when people run from these type of instruments very quickly. In other words, if there's a run on stablecoin. So now let's consider a scenario in which there would be a run on stablecoin. Well, we saw that the credit quality of stablecoin isn't particularly high, so a reasonable trigger might be if there's a credit sell-off, because then the value of commercial paper would fall and the assets of stablecoin would also fall. And that would mean that stablecoin wasn't fully collateralized. In fact, that's already happened during the sell-off in February and March 2020, because commercial paper sold off alongside equity. But of course, at that point, the market cap of stablecoin was much smaller. So if we combine that with social media, which means that panics can spread very quickly via Twitter, via Reddit, via TikTok, suddenly it becomes a race to be out of stablecoin first. Everybody wants to sell before everyone else. In fact, in summer 2021, there's already been a run on a stablecoin called Iron and its associated tokens, Titan and Steel. Over the course of a few days, there was this avalanche of fear and selling, such that the value of Iron fell from $60 to $0. On their blog, the people who run Iron said they were sorry, but that's pretty cold comfort if you've lost all of your investment. Another potential problem is to do with the liquidity of the assets which the stablecoin owns. You might be able to sell the stablecoin very quickly on cryptocurrency exchanges. However, the stablecoin can't sell the assets quickly enough to redeem its investors. This also happens to high-yield credit funds, which also hold illiquid assets. So for example, in 2015, there was a wobble in the credit markets, not a very big one, but Third Avenue had to shut down their fund. So it may be that stablecoins have to be gated, people can't take out their money, in the event of one of these crises. So if there's too much commercial paper being sold too quickly, and remember it's not only Tether doing this becomes a self-perpetuating problem, as all of them have to dump commercial paper into a market which is only trading one way. So this is a pathway by which a sell-off in stablecoin could also affect money market funds. It's because, if you remember that picture of the pigs, they buy the same assets, and the values of money market funds depend on the value of the same things as stablecoin. Now that stablecoins are much bigger, they're going to have a much bigger impact on prices. So I think stablecoin has been so successful and grown so rapidly that it now poses a systemic risk. And there's a pretty clear pathway which goes from a run on stablecoin to a disruption of money market funds, which in turn would spook equity markets. And then we'd be looking at another financial crash. Oh, and don't forget the special offer from Noah, for which there's a link in the description below. And as always, thank you for listening.